welcome to the FII View with me, Tanveer Gill. My guests today on the show are Timothy Moe, Chief Asia Pacific Equity Strategist at Goldman Sachs, joining me from Hong Kong, and Edward Teather, who's a Senior Economist, ASEAN and India from UBS. He's, of course, joining me from Singapore. Great to have both of you on the show. Of course, a little later, we'll also be joined by Rajiv Malik of CLSA to talk about India's macro situation. But first, Timothy and Edward, thanks very much for taking out the time to speak with us. And Timothy, let me begin by asking you, what do you make of the rally in the markets that we've seen since the election result? Is there more upside to the market from these levels?
Well, markets are never a one-way street, and we've already started to see some correction or digestion of the gains in the last few days. So it's not, I don't think, surprising to see the market pause to regain its breath here for a little bit. If you look at some of the technical indicators in terms of short-term momentum, the RSI, for example, was up at 85, which is a very elevated reading just last Friday. So I think that there are a number of reasons to expect some sort of digestion of the gains while the market looks for the next confirmation of the positive broader story. And that's likely to be in terms of the immediate actions that the new administration takes, and also specifically in terms of the new budget, which would be deliberated and announced coming up next month. So I think right now we're probably in a little bit of a pause for breath, digestion of gains phase. But I think the bigger picture to emphasize is that we think on a longer-term basis, on a 6 to 12-month view, that we think the market is still appreciably higher from here than it is currently.
Edward, come to you. What's your long-term view on India? The key question really being, when will growth revival happen? So when do you expect growth to pick up?
Well, by growth being revived, I assume you're talking about a return to very strong rates of growth north of 6%. Our feeling is that that's going to take time. There's a few things that reforms that the government needs to do, which actually aren't going to be very helpful for growth in the very near term. The government really does need to get inflation under control. That means leaving interest rates high. It needs to bring the fiscal deficit in. That means that there's not a lot of room for fiscal stimulus, and also there are bad loans in the banking system that could act as a bit of a drag as well. So sorting these things out will take time. Once those are done, India has a huge growth potential going forwards if the right policies are put in place. But those steps that need to be taken first could still be a bit of a drag on growth.
Edward, but recovery is to come with a bit of a lag effect. We're not going to see overnight pickup in economic activity. So time-wise, how much time do you think it would take for growth to pick up in India?
Yeah, I think it's difficult to say that things are going to change overnight. What the Modi government can do to boost growth in the fullness of time is get inflation down. Getting inflation down is painful, but once it's reduced, that's a major plus, because high inflation has a corrosive effect on growth potential, because it adds static to the price signal and makes it more difficult for firms to make decisions or accurate decisions. So getting inflation down is one thing. The other thing is making the business environment more friendly, reducing bureaucracy, increasing efficiency. And those two things, when combined, should set the stage for stronger growth in the fullness of time. It's just that we can't expect this to kick in over the next 18 months in a really big way.
Timothy, come to you now. While you're talking about upside to the markets from these levels, largely led by underlying macros improving and growth reviving, where do you think leadership will come from in the market? We've already seen the trade favoring cyclicals play out. What will lead the market higher from here?
Yeah. Clearly, the cyclicals have started to move, but I still think that there is some catching up to do. I wouldn't say that all of that has been reflected in share prices, or put it this way, if the fundamentals that we think will develop in terms of the economic cycle improving and corporate earnings beginning to recover in terms of their growth rate from this year into next, there probably is still more to go in the cyclical space in our view. So our general preference within the market still remains being overweight cyclicals and less optimistic on the defensives, or less weighted in the defensives, and then also trying to focus on beneficiaries of reform, which obviously is a well-flagged theme at this point.
Right, Timothy, post the verdict, FIIs and domestic investors have been net sellers. Despite the market's resilience, we haven't been seeing institutional investors put in incremental capital in the market. How do you look at the market's move and correlate that to the trend that you're sizing up or studying on the fund flows side?
It is a good question. I mean, overall, there has been net foreign buying in the Indian equity market, so certainly that is helpful. I think that, at least judging from a number of recent conversations that my colleagues and I have had with various institutional investors, I think people are asking the same sort of question that you just did, which is a very reasonable one, which is, look, we've had a very strong and powerful move in the Indian equity market. It's up, depending upon which day you measure it, close to 17% for the year. And, clearly in the short term, it's a bit on the so-called overbought phase. So our sense is a number of people are waiting and looking for opportunities to re-engage, but maybe taking their time in doing so. So I think if the market was to pull back a little bit from here, and we're not saying that that's our forecast, but it certainly would not be an unreasonable thing to see occur. Our sense is that there's a fair amount of money that's waiting on the sidelines looking for an opportunity to re-engage. So we wouldn't really be too overly concerned that in the last few days we haven't seen as strong a presence of institutional buying as one might ultimately expect and hope for.
Edward, talk about the same point. I mean, how does one look at the current market environment and how does one invest in the current market? Most investors in developed markets and, the stronger emerging markets are in the money. They are sitting on profits. Despite tapering, there has been favorable appetite among investors. What is the strategy from here on?
Well, I think they're both driven by the same thing. Equities are reacting to growth, and the Fed is reacting to growth, and as people get more faith in growth prospects going forwards, then that will mean both that people's faith in the investment environment, people's faith in company performance will improve, but also it will mean that the US Fed moves further down the route towards tapering its monetary stimulus.
What about policy action? Specifically talking about India, how do you expect policy action to kind of encourage the markets from here on? Do you see the RBI being in pause mode for a while? Well,
the central bank has laid out a policy framework for us, and that policy framework is very much centred on getting inflation down. That's very important, as we've discussed. I think the near-term target of getting inflation towards 8% by the start of 2015, from where we are now, is pretty achievable. The sort of ingredients you need to get inflation down, which is growth being below par, which is credit growth having slowed, already in place. So I think the Reserve Bank can just leave policy rates where they are and wait out, and that should and we should see inflation come down on that sort of 6 to 12 month horizon.
Timothy, I know that you're very bullish on the market, but there is an assumption in the market or an expectation that with 7,500, we've seen 80% of the rally down post-elections. Do you expect more upside, and what will lead to that upside, given that you have a target of 8,300 on the index?
Well, as we indicated in our recent report that my colleague Sunil Cole and I authored, we think that our 12-month target for the Nifty is 8,300, which, as of yesterday's close, is about 11% higher than here. When we published the report, we had 15% upside, but the market has had a nice appreciation just in the last few weeks since the announcement of the election victory. So we still think that there is some meaningful appreciation that can occur, and I think there's also could be upside to those numbers. In other words, the target that we have is not an outlandishly constructed one. It's not as though we've put everything in the proverbial shop window. And to be specific about that, I think that there could be some further room for upward revision of consensus earnings estimates. As we've noted in our recent work, we're starting to see some positive revisions on balance by domestic analysts as they begin to factor in a more favorable fundamental outlook and policy outlook into their earnings forecasts. And then, of course, the valuation target that we have used for that 8,300 Nifty target is 15 times earnings, which is actually a little bit lower than where we are today. So we've been, we think, quite level-headed and possibly a bit conservative in our aggregate valuation forecast. And to refresh your memory, the Indian market has traded on average about 15 times over the last 10 to 15 years. but it has reached peaks of 22 plus times earnings. Now, we don't think that obviously would be an extreme. We're not calling for that. But in an environment where you have a cyclical upturn and where you have the kind of significant change from a leadership and policy perspective that we currently have, it would not be unreasonable to see the market having at least some moderate further valuation expansion. So we haven't baked that into our numbers. So if you wanted to get more optimistic and have maybe a 16 or 17 times target multiple and a little bit higher earnings, you can do the quick math, on that. But that could lead you to maybe, mid 8,000s or even high 8,000s on the Nifty, which could still be appreciably, higher than it would be like mid-teens to high teens upside from here. So, we're not making that our base case forecast, but certainly would not be unreasonable to think that there could be some further upside there. So I think the general view that we feel comfortable with is that there still is clear fundamental upside for the market. Short term, we're probably a little bit extended, and we need to have some digestion, consolidation of the gains, and maybe some further news flow to verify and consolidate things. But we could still go higher.
Timothy, in terms of opportunities in the market, you had a strong buy call on PSUs, which has worked out pretty well. PSU bank managements, of course, have indicated that the non-performing assets are still a bit of a concern. Do you still have a high conviction call on these banks right now, PSU banks essentially?
Yes, and this I think is a significant debate, and I think the PSUs I think would be a specific example, in fact probably a very targeted and almost marquee example of the larger question you've asked about the overall market, which is really the intersection between recent price performance, the fundamentals, and the expectation and how things may turn out. And to be more specific about that, we obviously have seen some very pronounced share price appreciation as the market has gone from a quite cautious fundamental view to pricing in a greater degree of confidence that there will be a cyclical improvement and that fundamentally that will pass through into perhaps less credit stress than was previously feared for the PSU banks, and then a corresponding improvement in their valuation. So there's no gainsaying the observation that the banks are the entry point for them from a share price standpoint is less attractive now than it was with the benefit of full hindsight 6 weeks ago. Now, as you correctly said, I think the real crux of the issue here is what happens in terms of the credit cycle, because that will be the big delta, the big change in terms of how the fundamentals for the banks pan out. Now, I realize I'm speaking with a broad brush, and one has to go and look more specifically at each particular bank, but I guess the general flavor of our view on the credit cycle is that there are a reasonably large number of assets, of course not all, but a reasonably large number in the infrastructure space and the investment space, where the assets are stressed not necessarily because the businesses are bad businesses, but because they've been constrained in terms of their operations and their cash flow by constraints in terms of either project approvals or other kinds of required administrative approvals. Now, if there is some ability to address those in a timely manner, and that, of course, is what the market and we are expecting.
Edward, the other key question in the market is what will drive up asset prices from here, because it's either a recovery in the growth cycle, which is essentially productivity gains, or hope that growth will revive, so the market runs up in anticipation of that, or improvement in the global liquidity environment, which will push up asset prices. What, to your mind, will be the key driver for markets to move up from here?
Well, asset prices are always driven by sentiment, and India has an advantage here in that sentiment should, or the new government has an opportunity to improve sentiment by laying out a program of policies, of reforms that will make it easier for firms to go on and make profits and employ more people in India, and that will shore up the demand for spending ultimately. But it's the sentiment and the expectation of that happening or not that will drive sentiment and markets.
Edward, since the start of the year till now, there has been growing opinion about how India is standing out among emerging markets. But, just recently, according to Rajesh Sharma of Morgan Stanley, India, if you just look at from a long-term perspective, from a historic perspective, has not really outperforming emerging markets in a big way. It's pretty much mapped what the other emerging markets have done. Do you think that that is fair this time too, or this time is a bit different because we have a new government in place and there is promise of change?
Well, it's a very interesting point. I mean, on one level, of course, India is not different to other economies. It's driven by the same incentive structures. People react to the same, policy stimuluses and try and work to better themselves in the same way that they do everywhere else in the world. Perhaps the difference that India has right now is that, especially when we look at the rest of Asia, the rest of Asia has been having a boom in the last few years. You've seen domestic demand has been strong, you've seen credit growth be strong, you've seen leverage rise, and that's been good while it's been taking place. India, on the other hand, has been seeing credit growth slow and growth slow, but there can come a time when those two positions reverse, and India is probably in a better position going forwards to enjoy a turn in the credit cycle, a turn in the growth cycle, than the rest of Asia is to see an acceleration from where it is right now. Now, that makes India a bit different. I'm not saying it's going to happen over the next 12 months, but certainly if the government puts the right policies in place, gets inflation down, it is something that can happen on an 18 to 24-month view.
Edward, I know we've spoken about India and emerging markets, but it's also important to get your outlook on the US, the economy and the markets there. US equities have actually held up despite the Q1 data, GDP data that is, being weaker than expected. What is the US market pricing in right now, and what do we expect from the market as well as the economy going forward?
Well, I think you've got to bear in mind, one, that first quarter GDP data was some way relating to a period that's now behind us. Moreover, a lot of the weakness in that Q1 GDP, according to UBS's US economics team, was due to lower inventories. And lower inventories in the past can mean higher activity in the future as firms try and rebuild those inventories.
All right, Timothy and Edward, thanks very much for joining us and giving us your quick views on the Indian market as well as the economy. We'll Rajiv Malik, a senior economist at CLSA. He joins me from Singapore. Rajiv, good to have you on the show. What is your own view on the growth cycle in India right now? How are you mapping it?
Well, for quite some time, the Indian economy has been literally riding the bottom, and that will continue at least for a quarter or two. We will see growth coming back, taking on a bit more life later this year, and then showing a lot more significant palpable signs of increased mojo for FY16, which is why, while the growth trajectory will improve in the current fiscal year, the much bigger kicker will only come in the following fiscal year. But the more important thing is we are going to be on an improving trajectory, and the upside is really going to be capped by the kind of policy measures, including reforms, etc., that the government can put in place. Don't forget, in the very near term, one of the big advantages of the new government and Mr. Modi's own track record as an economic administrator is going to be to reverse the policy paralysis, which was one of the significant contributing factors for the big slump in growth. While many of the delays are because of state-level reasons, overall, I think purely getting a more efficient hands-on economic administrator will do the trick in the coming quarters.
Rajiv, I know this policy has largely been in line with expectations, but last policy, RBI flagged off several risks to inflation, including revisions to administrative prices and less than normal monsoon because of El Nino. What is your own expectation? How are you looking at the trends of the pattern on CPI inflation, over the next 6 to 12 months? Because that's going to be an important variable.
One of the important aspects of RBI's guidance last time around was that even though headline inflation will come off in the second half of the year, one should not necessarily get swayed by what is largely going to be a base effect playing out. And that's a very important indication, because in India's case, everyone only goes with the headline print. So here is a central bank that's in a way telling you, listen guys, you aren't going to see a rate cut simply because headline inflation will improve because of base effect. So I would actually be very surprised that we see any monetary easing from the RBI this year at all. Don't forget, this is about really managing the broader growth inflation balance on a much more sustainable basis. It's not really winging it that for 3-4 months you see an improvement and suddenly monetary policy changes direction and then suddenly you're stuck with something else. So I think the budget in early July and how the monsoon shapes up are going to be very important inputs Equally, what the government is able to do both in terms of having a plan in dealing with the supply side issues is going to be very important as well. The quality of fiscal correction, headline Botox related numbers are just not going to do it. We have to see clear-cut fiscal correction, good quality, which is sustainable and has to, of course, include, subsidy pullback.
Rajiv, there's growing opinion that the new government has an uphill task to expand the balance sheet to revive growth, so whereby which we will see, the deficit numbers ease a bit. Do you expect that as well, or do you think that the deficits will continue to shrink going forward as the government steps up its efforts to revive growth?
Well, I think the starting causality that somehow you require fiscal pump priming to get the economy started is actually incorrect. Don't forget, we've seen fiscal slippages actually creating a more hostile environment as far as growth is concerned. The need of the hour for sustained recovery is actually good quality, lasting fiscal correction, which then opens up whether it's funds for the private sector, whether it allows rates to actually come down as inflation also eases. This myopic near-term fix, which, politically can be very appealing that, oh, we should just have a wider fiscal deficit and growth will begin to improve, is not something that should apply to India in the current situation. So I really hope the government is very mindful of continuing with a very consistent signal of sustained and good quality fiscal correction. This is not the time to open up the fiscal taps. And that doesn't mean that higher spending for capital expenditure should not be there, but that has to be counterbalanced by some other expenditure items or revenue enhancing items so that your aggregate picture actually continues to improve. That is really the need of the hour.
Fair point. Rajiv, thanks very much for joining us and giving us that quick take on India's economy and the macro situation. With that, we come to the end of this edition of the FII View. Thanks very much for watching the show. We'll catch you with another special guest next week.